Hi guys, I'm Michael Glass from SEM Forex, and we want to welcome you back to our video series on how to be a successful trader. Before we begin, we always like to start off with our disclosures. Any trading you do is solely your own choice. No matter what form of investing you choose, stock, forex, futures, options, there is a chance of risk of loss. You can lose money. Any strategies or concepts we cover today are for educational purposes only. Trade at your own risk. So again, we want to thank you for participating and viewing our series on how to be a successful trader. We're trying to put you in the framework, trying to give you the habits of what successful traders do to be consistent on a daily basis. Doesn't mean they always win, but it does mean that they're putting themselves in positions to win consistently. High probability trading. To do that, we put together 5 videos. Do you know what time it is? In that video, we talked about understanding the type of day and the time of day to be trading and how that helps you be successful. In chart patterns, we talk about not specific chart patterns, but how we can use chart patterns in conjunction with the type of day to be successful. In the last video, we talked about technical indicators and how we can use those for confirmation. Again, not endorsing this indicator or that indicator, but talking about how we can use indicators to identify overbought, oversold conditions, using our market internals to understand momentum, using indicators for support and resistance. We talked about the categories that indicators fall in and how we can use them, again, to layer up into our process to be a successful trader. Today we're talking about money management, stop in the name of money. And the last video is fitness of trading, and that is all about the psychology of trading. These last 2 videos, stop in the name of money and mental fitness, really key. People go on YouTube and Google and they search for strategies, but they really have to focus on how they're changing themselves internally and not externally. So again, today we're talking about stops and money management. Rule number 1 of trading: cut your losers short, let your winners run. That is the golden rule of trading, and hopefully we will help you do that today. Now, a stop basically is an order that gets triggered mechanically. You set it at a price level, and when price gets to that price level, it gets triggered. It's a great way to initiate a position, and it's also a way to close a position. If you're using a basic stop, it is once price level comes to that your designated price, an order is executed at market. There's no guarantees you'll get that price if you're using a basic stop order. Now, the reason we use them is we use stops in terms of money management. Yes, you can use stops to enter a trade, but we use stop losses and trailing stops to limit our losses. And then more importantly, these last 3, we automate our trading, we promote rules-based trading, we remove our emotions from our trading. Again, we want to layer things to be successful. And the way we do that is by following rules. And by having stops that are automatically placed in, we're automating our trading, we're removing our emotions, and we're letting our system work for us. We're not working against our system. Now, as we talked about, there are stops, and we said stops are executed at a market price, and then our limit prices, buy limits, sell limits, and same thing with stop limits. Those are executed at that specific price, but they're not guaranteed to be executed because they're a limit. So one thing that's important when we talk about tips or tricks is to understand the investment vehicle that you're trading. You need to know whether or not you can use just a regular stop or a stop limit. If you use a regular stop and it's a very volatile instrument, you could get a really bad fill, which affects your chance of being successful. You make your money when you buy. But if it's a liquid market, you can use a basic stop, and you know that you're not going to get a bad fill because it's so liquid that you're just going to get triggered in. You want to use stop limit orders on a liquid market so that you don't have bad fills. So understand the nuances and the swings of the vehicle that you are investing. If you are in a winning trade, sure, move the stop. Some people, again, how you trail your stop is up to you. By percentage, by points. I always say, you want to hide your stops. But there's nothing wrong with protecting profits. Again, cut your losers, let your winners run. And finally, make sure you don't move your stop to give it more room. Rules-based trading, set it and forget it. Because typically when you're moving your stop, you're making an emotional decision, and it's never going to work in your favor. When I make emotional decisions, it never goes in my favor. But if you know your investment vehicle, then you should know where you place your stop to begin with, and there should be no need to move it. Now, some mistakes that people make when they're placing their stops is not understanding the strategy or the plan that they're trading. They go on Google and they find this great trading system, but it requires a 50 pip stop. Well, you can't handle that. You do a 20 pip stop. Well, then you're no longer trading the plan as designed, and that's causing you to get stopped out. In addition, you have to be comfortable with the heat. And I know that's one of the biggest things for me, why I had to set and forget, because you have to be comfortable by taking heat. So again, by not moving your stop, by not getting into the emotions of the stop, being comfortable is very important to being a successful trader. Another mistake people make is setting your stop at a specific number. You need to be logical, not technical about your stop. I do a 20 pip stop. Why? What you need to be doing is hiding your stop behind logical places, behind support, behind resistance, behind a moving average, behind the trend line. Just saying 20 pips, that could be in the middle of nowhere, and it could just go right down, take you out, and swing back in a regular direction. You want your stop to be where your trade is no longer working. So again, not understanding the volatility of your market, and which means you have placed your stop too tight, is another reason why you get stopped out and it doesn't work. Now, there are a variety of methods for placing your stop. Volatility stops, as I endorse the support and resistance. We talked about a determined amount of points or a percentage behind a moving average, trigger reversal, where does this trade no longer work, a trend line. All of these are great ways to know where to put your stop. Some work better than others. You need to test them out, and again, find out which one best works for you. What's more important is for you to know your risk before you enter your trade. You need to know where your stop is before you enter the trade. You also need to know where your target is before you enter your trade, and that helps you understand your risk to reward ratio, and that's going to affect your performance of your portfolio greatly. I know people, there's a guy that I listen to from time to time who always talks about how the fact that he always trades 3-to-1, sometimes 2-to-1, but because he trades these big numbers, 2, 3, 4-to-1 ratio, he can take stop outs because, as he says, it only takes one good trade to wipe out any losses and put them in the good. However, if you're taking a lot of losses and you don't have a big enough, if you're doing 1-to-1, how many times have this happened? You were profitable for the week, and then you take one stop and it wipes out your profits, or for the day. The week might be a little bit more, So again, understanding your risk to reward ratio is very important to the performance of your portfolio. You need to know your risk before you're entering a trade, know where your stop is going to be, and know where that is in reference to your risk. Because nothing like being profitable for a trade and being stopped out because you didn't know this is where my risk should have been. My target should have been here. Similarly, can you handle the risk? A lot of traders are afraid. A lot of traders hate being wrong, and a lot of traders can't afford the loss. Losing is a part of trading. You have to be willing to handle that. So don't be afraid to take a little heat. Don't be afraid to be wrong. It's a part of trading. But if you define your edge and know the type of trader that you want to be, and you know where your risk is and you know where your reward is, that will allow you to be successful. It will allow you to be a high probability trading, because we all know, and we say this in every video, successful traders identify opportunities and they apply the right strategy. In addition to applying the right strategy, they know where to place their stops, where to hide their stops so that the trade can work. High probability trading is all about understanding the playing field, knowing the volatility of the market that you're trading so that you can know where to place your stops so that you're not going to get stopped out. That doesn't mean every trade is going to work, but it is mean that you're not allowing the professionals to run stops and to run you out. You understand that there are logical places that you can place your stop to put the odds in your favor, but more importantly, you're able to distinguish between the types of trade that you want. Sometimes you just have to center on the sidelines. And what I mean by that is, we talked about, in reference to stops, we talked about not buying in space. And so you may want to sit on the sidelines because you may want to let the market come back to a more logical place to get into a trade, because by getting into the trade at the right spots, we are identifying our risks, we are increasing our reward, and having a good risk-reward ratio is what high probability trading is all about. So guys, this is it for our stop in the name of money. If I was to sum it up, it's basically two things: cut your losers short, let your winners run, and understand your risk to reward ratio. So again, in our 5-part series, we've talked about many things. In our next video, we're going to talk about the psychology of trading. Thanks guys, and I'll see you next time.